what's your sort of, I suppose, working assumption for the shape of the sort of the recession? I mean, is it U into a V? People, I don't think anyone expects a V, but are you a sort of a U or an L?
I think probably a U. Yes, in terms of that analogy, I think it's interesting that usually, it's right to buy probably the latest. The market will start to recover 2 or 3 months before the worst of a recession. Here we know that I think it will return reasonably quickly. Going back to 1974, it took 7 years for markets in the UK to get back to where they were at the peak in 72. So full recovery can take some time. And we saw that after the dot-com boom and so on as well. But I think rebound could be reasonably sharp given the extent to which China is returning back to production. And I think there's certainly more consideration of the balance between economics and the human cost here. So I do think we're going to see politicians mindful of that as well. And I think we probably know as a backstop there'll be some sort of eventual medical resolution, and whether it's in terms of treatments and that sort of thing. So we're probably not looking at something that would last more than 18 months. The problem is a lot of small and medium-sized companies, and to some extent we've had a nationalisation of some of the Western economies, and that's been an interesting, I think, experience perhaps to see just what the political will is to unwind that in different areas. And I think while the economy might recover, we may be seeing less of the share buybacks that I mentioned, dividend cuts too, just because people can do that, and it makes no sense to keep them up. So some of the landscape afterwards in terms of shareholder returns and the political landscape will be harder to guess, I think.
Yeah. And what do you think, I know it's rather a broad question, but what do you think the impact is going to be on the investment management sort of sector and the profession generally? Because, retail investors don't love, high levels of volatility. Is this going to diminish people's confidence in investing in markets? I suppose if the markets come back in a hurry, then people might forget. And as you say, we haven't seen very high levels of retail activity. So perhaps if people feel as though they're sitting on a loss now, but in 2 months' time they're only sitting on a loss of 5 or 10%, it may sort of change people's views. But it obviously is a very worrying time for people, both in terms of health, but also in terms of their investments.
I think it is worrying, and I think for those who've been exposed more to equities than they now really see the risk appetite for. Yes, I mean, this is the first time we're really going through things with these notices of 10% reductions, and once you've sent a couple of those out in the space of a few weeks, yes, you wonder just what an investor would make of that once they have a chance to sell higher up. It does look at the moment as though markets won't be suspended. I think that has been a concern, and the UK short selling has not been stopped. So there's a reasonable amount of functioning going on there. And it'll be harder, I think, for people to see how to diversify to limit that. Although clearly 60-40 portfolios and some diversification would undoubtedly have helped. But I do suspect coming out of this, quality growth, given low interest rates, is going to come back again, and we might be looking at percentages that have certainly improved quite a bit from where they looked 10 days ago.
Yes.
So I started in the investment profession at a time when there had been that big sell-off. I fortunately came in just after it, so I felt very much at the time that everyone else was far too risk-averse, and I think with the boldness of youth, I found it a lot easier to look for value amongst small and mid-cap, and sometimes these what are traumatic events for the financial sectors. I think there's sometimes not a bad time for young professionals to come into the industry, and